there seems to be a lot of speculation about the U.S. economy. So let's start by saying the U.S. economic outlook for 2015 will be significantly different depending on your vantage point. If you are wealthy, 2015 will probably be another year of celebratory wealth creation. If, on the other hand, you're not wealthy, 2015 will feel an awful lot like 2014, 2013, 2012, 2011, 2010, and 2009. Wall Street and the U.S. government will tell you the economy is doing well, but it won't feel like it. In fact, according to a national survey, 70% of Americans believe the U.S. economy is permanently damaged, while 84% do not believe the economy has improved since the recession ended in 2009. Now, how can this be? How can we have these two polarized data? The stock market is, after all, the barometer for the country's economic health. Since the market's bottom in March of 2009, the S&P 500 has climbed approximately 200%. The New York Stock Exchange is up 165%, the NASDAQ 260%, and the Dow Jones Industrial Average has gained more than 165%. With major U.S. indices reaching uncharted territory almost daily, many have concluded that the U.S. economy has recovered. Well, unemployment levels have dropped to just about 6.1% and inflation is in check. Further, the Federal Reserve is winding down its bond buying program at the current rate, which means that they will wrap up its quantitative easing, the QE, strategy this fall. Mission accomplished? We'll see. The fact of the matter is that the U.S. is doing spectacularly well. Well, Wall Street is. A, the economic background. Let's understand history. The Great Recession in the U.S. started in December of 2007 and lasted for 18 months. In late 2008, in an effort to help kickstart the economy, the Federal Reserve initiated its very generous bond buying program, the quantitative easing, the QE, and sent short-term interest rates tumbling to near zero. The low interest rate environment was supposed to encourage banks to lend more money so that businesses and people could have them. This didn't exactly happen like it was supposed to. What happened instead? Instead of making it easier to get money, America's big banks tightened their lending rules, taking the opportunity to strategically invest the money themselves. Granted, the banks were more than willing to lend to well-heeled Americans. Understanding this means that they're keeping interest rates artificially low, which made it cheaper to borrow and is generally recognized as the fuel that is being propelling the stock market increasingly higher. Since the Federal Reserve enacted its quantitative easing strategy, let's see, the S&P has soared more than 200% in value. During the same time frame, the number of Americans receiving food stamps has essentially doubled to 46.23 million, or 1/6 of the American population. As a broader measure, since this so-called Great Recession began, the top 1% of earners have seen their incomes rise more than 30%, while the bottom 99% saw their earnings rise 0.4%. During the so-called recovery, the top 1% captured 99% of the total growth in the U.S. Unfortunately, the widening gap has slowed the 5-year recovery and contributed to the Standard & Poor's, the S&P, cutting its growth estimate for the economy. Because, let's see, in part, of the income disparity, S&P estimates the economy will grow 2.5% annually for the next decade, down from a forecast 5 years ago of 2.8%. This is a little less optimistic than what the International Monetary Fund, the IMF, had or has projected. In 2012, U.S. gross domestic product, GDP growth was 2.8% in 2013, slowed just 1.9%. In 2014, the IMF expected the U.S. GDP growth to be 2.8%. Now it expects to be 3%. B, unemployment analysis and forecast in the U.S. Again, the stock market may be doing well, but the underlying fundamentals that hold the U.S. economy together are not. Yes, the jobless rate is down to 6.2% from nearly 10% 4 years ago, but the numbers is a little misleading. Other gauges have become harder to assess and may reflect persistent weakness, including the number of people jobless, which is more than 6 months, the millions who are working part-time and want full-time jobs, and stagnant wages. On top of that, the unemployment rate, the U-6, remains at an eye-watering of 12.6%. The employment situation in July of 2014 was an article that was sent about this. For those who have jobs, they're making less than they did before the Great Recession wages. For workers at every pay level, save for the bottom 10%, declined from the second half of 2013 through the second half of 2014. And there is no indication wages will actually, in fact, increase. For 70% of the workforce, inflation-adjusted hourly wages are still lower than they were in 2007. Over the same period, inflation, CPI, has risen about 15%. The best time to be a worker in America was basically in the late 90s, when wage growth was broad-based and strongest for the lowest income earners. Even U.S. housing, the bright spot in the U.S. economy, isn't as robust as many think. The Case-Shiller Home Price Index may be up 25% since the beginning of 2012, but it still needs to climb an additional 20% just to break even with its pre-recession levels. C, real estate. Despite the ultra-low interest rates, first-time home buyers like yourselves are being priced out by all cash purchases. As a result, the number of first-time home buyers getting onto the property ladder is lagging, accounting for just about 28% of all purchases, the 30-year average, and a number that economists consider to be healthy is 40%. The National Association of Realtors also notes that nearly half of Americans said student loan debt is a huge obstacle to buying a home. First-time home buyers are an important part of the U.S. economy, and if they don't buy homes, they cannot pay for upgrades, renovations, appliances, or furniture. If they aren't buying, construction companies aren't building or employing as many people either, and that adds up. Historically, residential investment, construction, remodeling, etc., has averaged around 5% of U.S. GDP. Housing services, which includes gross rent, utility payments, and imputed rent, an estimate of how much it would cost to rent owner-occupied units, averages between 12% and 13% for a combined total of 17 to 18%. D, an analysis for you, investors. Despite the obvious, which is the economic warning signs that we see, investors like yourself are not yet ready to throw in the towel. And they continue to be increasingly optimistic toward a stock market that many believe is both overvalued and ripe for a correction. But it appears as though investors don't care if the markets are overvalued, so long as it keeps going up. While bearish indicators continue to surface on a regular basis, there is no reason to think that the markets are going to correct in the near term. To appease shareholders, companies are going to continue to financially engineer their earnings while using cost-cutting measures and cash to repurchase shares and increased dividend payouts is a short-term investment strategy, which has been known to be used to boost earnings and support stock prices. More and more investors seem content with this strategy, as long as the money is rolling. Eventually, the companies will need to report sustainable revenue growth. And this is going to be the difficult part for a country like ourselves, like ours, which relies on consumer spending to drive roughly 70% of its GDP to run at a full steam when the vast majority of the population is struggling. So let's talk about the last topic, which will be the economic factors. The economic factors outside the US will also have a very serious impact on the US economy in 2015. Russia, for example, one of the world's biggest economies, is on the brink of a recession as a result of sanctions related to the ongoing conflict in Ukraine. We all know that Russia's economic ministry halved its 2015 GDP forecast from 2% to 1%. Now, this past summer, it was reported that Italy, the third largest economy in the Eurozone, had fallen back into recession. Germany, the region's largest economy, is grinding down, and France, the second biggest economy in the Eurozone, is also in a very precarious position. In the second quarter of 2014, we saw that Germany reported a decline in its GDP. This represents that the first decline was then since the first quarter of 2013. In August of this year, the ZEW, Indicator of Economic Sentiment, which is a survey on the health of the German economy, posted a massive decline, collapsing 18.5 points to a lowly 8.6 points. Now, having been declining for more than half a year, the index is now at its lowest level since 2012. This does not bode well as we head into 2015. France, the second biggest economy in the Eurozone, is in a worse spot economically, and a recession that may just be around the corner. In 2013, France's GDP rang in about just 0.4%. During the first half of 2014, France's GDP came in at zero. In addition to a stagnant economy, France faces record unemployment and a growing deficit. On top of that, Prime Minister Manuel Valls warned the autumn months would continue to be difficult. So the big question is, what in 2015? Well, it doesn't look like 2015 will be a prosperous year for the European zone, especially when you consider its three biggest economies are in jeopardy. Why should we, as Americans, be worried about the Eurozone economy? Big question mark. Well, approximately 40% of the public companies that make up the S&P 500 derive sales from Europe. If the Eurozone faces a sustained economic slowdown, the corporate earnings of our American companies will suffer. As a result, America won't be able to skirt the consequences of an economic slowdown in the Eurozone because of the US economy itself remains weak. After all, it's been the lethargic US economy that has necessitated near zero interest rates for 6 years, and there is a serious doubt as to whether or not the US economy can sustain higher rates. With that in mind, it's difficult to imagine the US could weather a global economic slowdown unscathed. That doesn't mean the stock market won't continue to do well. It all depends on when the Federal Reserve decides to start increasing interest rates. Initially, the Federal Reserve said it wouldn't raise interest rates until the US economy was on sustainable economic footing. I think they're misleading and they're not talking the right thing, because many take to that mean a jobless rate of 6.5% and inflation of 2.5%. The unemployment rate is already below the 6.5% target, and US inflation is near 1.5%. At the same time, there is no more to the US economy than those two indicators. It's quite possible the US economy will hit those targets in early 2015, and the Fed chooses not to raise interest rates because it believes there is too much uncertainty still. On that note, the Federal Reserve will announce on March 18th of 2015 whether or not it will raise interest rates from zero. If the Federal Reserve decides the economy is on the right path and raises interest rates sooner rather than expected, it is quite possible the stock market will go through a short-term correction. An increase of 50 basis points could shock the system and negatively impact the broader economy, making it more difficult for people and businesses to borrow and lend. Now, if this were to happen, investors like yourselves might want to consider banking stocks and growth stocks over the remainder of the year. The Federal Reserve would monitor how the economy is doing and decide whether or not to move interest rates higher or lower. Maintaining the current ultra-low levels would signal that there is still work to be done and that the rates will probably not rise until later in 2015, possibly October. If this happens, investors will, in all probability, remain bullish, sending the stock markets higher over the next coming 7 months, waiting to announce an interest rate hike until October 2015 would allow the U.S. economy more time to set itself on a more stable, sustainable course. It would also allow the U.S. economy time to better understand or assess where the global economy is heading at that time. Because an interest rate hike in October 2015 would be expected, it would come as less of a shock. As a result, the major U.S. stock indices would be prepared to absorb the expected hike, for sure. So what kind of companies thrive on higher interest rates? Well, few are looking forward to interest rate hikes more than banks. America's big banks have been the biggest winners of the Great Recession and quantitative easing. When the U.S. financial system was on the brink of collapse, the Federal Reserve and the U.S. government stepped in and bailed out America's big banks. We do remember this. The 6 biggest banks were given $160 billion and they borrow as much as $460 billion. They profited from cheap taxpayer-funded dollars. And America's big banks did well. JP Morgan Chase, the New York Stock Exchange, has seen its shares price climb almost 350%. Morgan Stanley has seen its share price increase more than 450%. Bank of America's corporations share price is up more than 500% since early 2009, and Wells Fargo and Company has also seen its share price climb more than 625%. Even in the low interest rate environment, America's big banks have made a lot of money, but low interest rates mean that there is no limit to what these banks can charge. With the country's banking industry on a very strong financial footing, America's big banks want interest rates to climb. When interest rates do start to increase, lending institutions of these banks will raise the amount they charge for the loans faster than they pay on deposits. For America's big banks, these higher rates will translate into much higher profits.